Alright everyone, Marco Palmero, founder of Ulysses in Dubai. I'm starting today a new series called Acquisition Case Studies. In this series, we're going to dive deeper into some of the transactions that we have sourced, negotiated here in the United Arab Emirates and in the Middle East. And I'm going to break down some of the challenges and problems that we faced and that we have encountered in structuring and negotiating these deals. And I think this series will be very important for all these business leaders, executives, and entrepreneurs, but also private investors who are looking to buy companies, buy assets in the United Arab Emirates and in the Middle East. Now, if you've been following the channel, you know that there's another series that is running called Deal Reaction. The difference between the two is that with Deal Reactions, we're going to talk about acquisitions that are relevant across the globe that might be significant for whatever reasons. So we might pick deals, large acquisitions that made sense from a strategic perspective so that we can analyze the story behind that deal and kind of build a conversation together, see why that deal made sense, what we can take out of the transaction, and how can we learn from it, so to speak. This acquisition case study series will be a little bit different because I'm going to use real life case studies that we lived and witnessed, either in person or on behalf of some of the companies we work with, so that I can potentially share some of the mistakes and problems that we encountered and help you avoid those mistakes, right? So again, it is a series that is focused on avoiding mistakes when looking at companies that are available for sale in the United Arab Emirates and in the Middle East. Companies of all sizes, and as you will see, we will be talking primarily about deals that didn't close for whatever reason, because I think that from mistakes and deals that don't close, you learn the most. And so from time to time, we might include deals that close successfully for us if they're not under non-disclosure agreement. But in most cases, we're going to be talking about fuck-ups. Let's just put it this way. So in order to maintain a certain level of confidentiality, I'm just going to share some general info about the deal so we can have a little bit of context. And then I'm going to talk about the reasons why the transaction had problems, why it fell apart, and what was the problem behind it. In most cases, we will see there were challenges with the sellers, but there are 5 key points that I'm going to break down in each case study. Of course, we're going to be talking about the years of operation of the business. How was the staff organized? Then, was there real estate involved in the deal, or was it just a plain and vanilla business acquisition? What was the reason for the sale? And lastly, we're going to be talking a little bit more about the financial aspect. I'm going to convert all the figures into dollars because in the United Arab Emirates, we have dirhams. In other countries of the Middle East, we might have different currencies, but dollars will facilitate the process and will help basically everyone consume the content. So without hesitation, let's just dive into this one deal, this first one, which was a transaction that I found about 2 years ago, something like that. And to give you a little bit of historical background on the deal, this was a very stable business that had been around for 20 years in Dubai, which was, kind of unusual, to be frank with you, and very good news. Then we had a staff personnel of about 20 people, out of which 10 of them were doctors because we were talking about a medical center. Real estate was not part of the deal, so we were talking about a plain and vanilla business acquisition. And the reason for the sale was that the business was kind of like an inheritance. So the owner received this business from his father a few years back, and now he was facing problems, more specifically health issues in the family, and he wanted to relocate back to his home country. So based on what he said to us in the very beginning, this was an issue that was time sensitive. It wanted to get out quickly because these health issues were serious. So he didn't want to spend time in the UAE, and he wanted to be in his home country. So it sounded like a pretty strong motivation, right? And given the first three aspects of the deal, so the 20 years of operation, at least 10 doctors in the business, and no real estate in the picture, that appeared to be a very suitable deal for us in our own acquisition criteria, because we were looking at the deal for ourselves. So we wanted to buy this thing. So everything sounded good, from the very beginning. So we sat down with the owners and we started analyzing a bit more what were the reasons behind the sale, was the motivation strong enough, and stuff like that. What we came to realize was that this person was a bit entitled about the business, and he felt that he deserved a lot more than the business was actually worth. Now, that of course was no surprise, because most small business owners generally ask for more money than the business is worth. So for us, that was just, another day at the office. I think what the problem was here was that the guy was not realizing that most of the results accomplished by the business was, thanks to the father, because he received the business only 12, 18 months before. So he was basically benefiting from that business that the previous generation had built. And, he wasn't really the one responsible for those results, if you get what I'm saying. But the guy was still pitching hard and was very convinced that he was the one, the driver kind of behind the success of the company. Long story short, he was asking for crazy terms, probably because of the time sensitivity of the deal, and he wanted 100% cash up front and just get out of the business as soon as possible. That appeared to be quite ludicrous. I mean, I have never seen a buyer in Dubai or in the United Arab Emirates or in the Middle East, for that matter, open to pay 100% cash up front for a deal, unless we're talking about a private equity group with deep pockets, which of course manages somebody else's money, so is less concerned about paying 100% up front. But I've never seen that being the case for these small deals, and that created a bit of a threshold for us to continue the interaction. Now, before we actually talk about how we started the interaction around the deal, let me break down the financial real quick, the financial aspect. So the deal was generating $2.7 million a year in revenue. So it's a very small business. The profitability was decent. We were talking about $500,000 in net, so $500,000. Although I have to say that I had seen businesses perform a lot better in the UAE, especially given the fact that they were not affected by tax at that moment. And so that wasn't really extraordinary result for a business of that kind. We have seen better results, but still, it was kind of acceptable. We were talking about, give or take, 21% net, because 2.7 was top line, 500 was the bottom line. So give or take, 274, 520, give or take, we were talking about 20%. Now, getting back to my point about the negotiations, these guys wanted 100% cash up front. Now, independently of the multiple they were asking us to pay, that was a little bit of a stretch. Now, we put down some terms that were comfortable for us, which I'm not going to mention in this video, but it appeared like that, pointed us and led us to a stalemate. So we were not getting any further with the deal, and after some time it became apparent that the guy was pitching other buyers, and he was trying to get the best out of the deal within a short time frame. Now, that wasn't a surprise, because that happens quite often in the UAE, quite often in the Middle East, and sometimes when we work with other companies, they get pissed off when sellers do that. But it is just a process that a lot of sellers go through in this region. They kind of like, they approach business selling and small business selling almost like being, at the fish market. They try to pitch a bunch of different people, hoping they're going to get what they want. So we said to them, okay, fine. If they want to deal with us in that way, let them go. They will certainly come back sooner or later, because nobody will offer them what they're asking for, right? So that's exactly what we did. We said, okay, if you wish to deal that in that way, you can come back to us. If you don't find any suitable party that is going to accept that offer, we'll be happy to reconsider it. Of course, on different terms, but that was subject for the second discussion. Now, why is this deal important, and why do I think it is a good teaching point? Because the guy came back to us 18 months later, and at that time we were able to understand how bad it was for the business and how he had affected the business in just 18 months. Why is that? Well, he called us back 18 months later saying, well, I haven't sold the business. Would you look at it again? Now, that initially was a bit of a red flag for us, because initially, if you remember, the main reason why he wanted to exit this thing was because he wanted to relocate outside of the country. He wanted to do that fast, and everything was very time sensitive. So that didn't sound right. Okay, 18 months later, you're still selling the business. You were in a rush, if I remember correctly. But anyways, we said, okay, just send us the updated financials. We'll take a look at it, and if that is meaningful, we will talk again. So he sent us the updated financial picture, and it was funny because we saw how 18 months under his management completely destroyed the business that his father had built. And it was apparent to us that it was a person that was ruining this business. And if he only had the capability of realizing that this business was his father's merit, he would have sold it 18 months before and capitalized on that. But he wasn't smart to do that. Now, why am I saying all this? Well, as he sent out the financials, he showed us a financial performance that went from $2.7 million in revenue to $750,000 in revenue in just 18 months. So the business fundamentally, decreased in performance almost by 75%, which was bonkers, really. And the profits, well, I got a summary right here. Let me pick it up for you. The profits were actually non-existent. So back in the day, they were making $500,000 net a year, which is not too bad. Like, it's 40 grand a month, right? Now they were negative, okay? And also some liabilities on the business, some bank loans and stuff like that. So we said, my God, this guy is completely destroying this business. There's no chance he's going to be able to ever sell this thing. And of course, for us, that was a clear no, because the moment we saw that financial picture, it was immediately a pass. But I think the lesson we took out of it is that sometimes sellers don't realize that the business performance might not be something that they created, especially when there's this complex situation of inheritance, right? And somebody else built the business and another generation is taking over. And so the guy implicitly felt that the business would have kept performing at the same level just because he just got it from his father and was doing well. Funny enough, as he started managing this thing, everything fell apart because he wasn't as capable as the father. He wasn't able to retain key personnel that left and went to other medical centers. And ultimately, this business fell apart. Now, other than the lesson that we took away, which is being careful when you deal with businesses that have just been passed on through generations, there's also this this idea of diving deeper into the motivations of the owners and understanding really what the guy is all about. Because back in the day, we didn't really consider the fact that this guy may kill the deal even if we were the ones running it, because it was kind of like common practice for us to keep past owners involved in the business for certain period of time after the acquisition closes, right? It can be 6, 12, 24 months. In this case, it would have been a nightmare, right? Because the guy would have been, an anchor that could sink the entire ship. And so I think that told us a lot about, inheritance businesses, and also being careful of the people you retain if you're planning to buy an asset. And I think what also teaches us from a selling perspective is that being entitled really doesn't help. And when you get suitable buyers on the table, you should really capitalize on the offer that you're getting, because you might not get another one. And you should also realize when the business is not your own merit, your own making, and kind of like try to get out of it when you can actually cash in. Now, I don't know what happened to the deal, to be frank. I'm assuming it's not going to get sold unless somebody wants to, take it all for zero and try to recover it. But I'm assuming that's never going to happen because the business is just too small. It doesn't justify doing it. Plus, the building that they were leasing is kind of old, so you should relocate to a new building. Quite a bit of challenges in turning a business around that was in that particular situation. Of course, if we were talking about 18 months before, it would have been a different case. And, be aware, we might have made a huge mistake, because we might have bought a business that was actually a company that another person had built, but he was not going to perform at the same level, because that guy was the driver of the performance. And so that kind of told us a lot about that and how we analyze deals. Of course, everything is a work in progress. But I think that was one of the key lessons we took out of this. And I think it was particularly relevant because many businesses are sold because owners want to relocate to another place, especially here in UAE. We have seen rare cases of business being passed on through generations, but that happens mostly with locals, of course, and it happens with big businesses. So for small assets, we have seen that being that happening less often, but that was one of the examples, and it kind of like showed us what we should be aware of before we actually get our hands into this deal. Now, thankfully, because of the guy entitlement, we didn't get involved in a deal that could have been very bad. But again, I think that was a good lesson, and that was the first of our acquisition case studies. Hope you can get some valuable info out of it, especially if you're considering buying a small business or a medium-sized company in the United Arab Emirates and in the Middle East. And I will see you in the next case study.